Welcome to another public live stream session. And man, am I super fired up to talk about the Federal Reserve's decision today to either cut interest rates or keep the interest rates steady at 5.25 to 5.5%. Or maybe they'll surprise us with a rate increase today in about 30 minutes at 11 a.m. Pacific Standard Time or 2 p.m. Eastern Standard Time. At the same time, the Fed is going to release the latest summary of economic projections that will give us a better clue about how many times they're going to cut interest rates in 2024 and maybe 2025, what their GDP projections are, and where they think the unemployment rate will be for the rest of the year and in 2025. And if you missed my live stream this morning, I went over the latest inflation report from the month of May, and I'm looking forward to watching what Jerome Powell will say at the press conference at 11:30 a.m. or 2:30 p.m. Eastern Standard Time, because I wonder if he's still going to say inflation has shown a lack of further progress toward our 2% objective, right? And when the last summary of economic projections, when it came out, we were predicting the Fed would cut rates at least 3 times this year, but now we're looking at possibly 2 rate cuts at the most, or maybe they don't cut rates at all in 2024. And we'll see what happens in about 25 minutes. And while you're watching this live stream, you can download my financial independence resources for absolutely free by visiting firesightshare.com/resources. People on the FIRE journey, pay close attention to this, to any changes to the monetary policy, which is governed by the Fed, and the fiscal policy, which is overseen by Congress. So the day is finally here. The latest inflation report came out this morning, and now we get to find out what the Fed will do today and going forward. Now, I want you to just make a note on your calendar, because check this out. On July 11 at 5:30 a.m. or 8:30 a.m. Eastern Standard Time, we'll get the CPI data or the inflation report for the month of June, and I'm going to be live streaming when the latest inflation report comes out. 3 weeks later, on July 31st, I'm going to be on live stream again when the Fed announces its decision as to whether it will raise interest rates, keep them steady, or drop them by 25 basis points. So mark it on your calendar if you haven't already, because this is going to be about 4 months before the election day. Are they going to cut interest rates in July, or possibly at the last minute on September 18th? Or maybe they won't cut rates at all for the remainder of 2024. And if you're watching this on replay, I'll be sure to leave the timestamps in the description below so you can navigate the Q&As and other source materials I'm going to show you throughout this video. And I'm going to switch things up just a little bit by starting this live stream with some Q&As. That's right. And then in about 25 minutes, the Fed is going to announce its decision to maintain its interest rates at 5.25 to 5.5%, or are they going to surprise us with a rate cut? Highly unlikely, but you have to remember that the Fed cutting interest rates so soon is not necessarily a good thing. It could mean that there's some economic weaknesses coming up in 2024, like we've been seeing now with the GDP, consumer confidence, and weakness in the labor report. At the same time, the Fed is going to release the latest summary of economic projections. And I want to look at what their projections are with the PCE inflation, unemployment rate, GDP, and the dot plots to see how many Fed governors or participants are looking hawkish or maybe even dovish. And then in less than an hour at 11:30 a.m. Pacific Standard Time or 2:30 p.m. Eastern Standard Time, I'm going to be live streaming Jerome Powell's press conference and the Q&As he's going to get from the reporters. And trust me when I say his words matter, they really matter. And I'm going to keep an eye on the stock market as he answers questions to the reporters. And the S&P 500 is already up. Quite a few today. It's already over 5,430 points right now at the time I'm live streaming right now. And it's up over 14.6% year to date. That press conference should last about an hour, but I'm going to go over the Q&As with you guys throughout the live stream. So feel free to put them in the live chat below. Let me take a look at this real quick. So, you know what? I forgot to show this. CME. Okay. Tap, tap, tap. All right. So before I get into the Q&A, let me show you what the CME group is predicting the Fed will do. It's pretty self-explanatory here, with a 99.9% chance that the Fed is going to maintain its interest rates at 5.25 to 5.5% today. And they're going to announce that decision in about 25 minutes. And I will agree that the Fed is going to maintain its Fed funds rate the way it is. And if you take a look at the prediction for the month of July here, the July FOMC meeting, they're also predicting almost about an 85% chance that the Fed will maintain the interest rates where they are. So if the prediction is correct, with 4 meetings remaining after today, they might not cut rates until September right here. And if you take a look at the September meeting, it's pretty much a 50-50 chance that they will cut rates in September. And there's a chance that they could cut rates again in November and again in December, but it's going to depend on the data. The summary of economic projections that will come out today will give us a better idea of how many rate cuts they're going to do. And this was the last summary of economic projections that came out in March. And I took a screenshot of it so I can draw on this. This document comes out every quarter. So we'll get the latest version in about 20 minutes. And I'm going to compare this document with today's document when it comes out later on. And what I'm going to be curious about is changes in real GDP. They predicted the GDP to rise 2.1% right there in 2024, but the Q1 GDP came in a lot lower at 1.3%. Okay, so could they lower the projection to 1.7 or maybe even lower to 1.5%? And then the unemployment rate right here right now is at 4% for the year 2024. And we just hit 4% as of last month of May. And I'm guessing they could change this number to maybe 4.2 or 4.3%. PCE inflation right now is 2.7% as of April 2024. And we're not going to get another data for that until June 28th or 2 weeks from now. And core PCE is already at 2.8%. And then down at the bottom here is where the Fed funds rates are. Okay, so right here and right here. And that's where I want to pay attention to. And that is the federal funds rate. The last one was 4.6%. And if you look on the right side, it was between 4.4 and 5.4%. And I want to see how this is going to change in today's report. Is it going to be higher or lower? And my guess is that we're going to see 1 or 2 rate cuts at the most in 2024. And I have the dot plots from the last summary of economic projections on the left-hand side, as you can see. And I have a blank space on the right-hand side when the latest report comes out in about 20 minutes. But if you look at where all the FOMC participants stood with the federal funds rate or a Fed funds rate, most of them were right below 5% here. And while 4 participants were sitting above 5%. Well, so that is what Wall Street is also paying attention to, because they want to know how hawkish the Fed has gotten over the past 3 months. And I also want to see where they stand in 2025, because this report from March show that most of them were below 4.5%, with one person sitting at the same rate at 5.25 to 5.5%. So this is going to be really interesting and see where that's going to take us. And Jerome Powell and the Federal Reserve, they have been under tremendous political pressure from both Democrats and Republicans as we get closer to the election day in November. From the GDP side, Donald Trump is already saying that he's going to fire Jerome Powell. And from the Democrats, they're sending letters to the Fed to urge them to drop interest rates immediately, because this election year is not about student loans, unemployment, or geopolitics. It's actually about the housing market and housing affordability, and how much American people can afford to buy a house right now. Home prices were up 6% in April from a year ago nationwide. And I'm in Las Vegas, and the home prices have increased by 9.2% year over year. Does this mean whoever Trump appoints will drop interest rates right away? That's not how it works at all. I don't think it matters who gets elected in November, because the Fed will continue to maintain its course to do what they think is best for its monetary policy. And even if Trump gets elected, the Fed is not going to drop interest rates right away. We're not going to see mortgage interest rates drop from 7.5% to 4.5% in a matter of a few months unless we see a recession or deflation going into the second half of 2024, which would be really bad for the economy. Now, we're not going to see those mortgage rates of 2% or 3% for a while. So don't expect those rates to happen anytime soon. And I just want to say that I can't thank you enough for continuing to support my channel. And I promise to continue to deliver you the content that you need to achieve financial independence so that you have the possibility to retire early. And this is a channel about FIRE, which stands for Financial Independence and Retire Early. I started my FIRE journey with over $110,000 in total consumer debt back in 2014. What matters more than financial education is your behavior. You have to be in the right mindset to start saving and investing for financial independence. And if you're brand new to my channel, go to firesightchat.com/resources to download all of my free financial resources, like the 401k calculator, Roth IRA calculator, or the financial independence calculator. If you want to go another step further, schedule a 60-minute session with me by visiting firesightchat.com/coaching and consider joining my private client program. But anyway, let's get into some Q&As here. Let me play this just real quick for the YNAB. So what do you think is better, investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. All right, so I'm going to start the question here that I got. Cool. All right, so let's see. Let me start with Instagram here. This is being live streamed to all the accounts, Facebook, Instagram, and YouTube all at the same time and using StreamYard. And you can use that in the affiliate link in the description below. So I'm going to start the question from Instagram. What are your thoughts on the money market fund with Fidelity? It says it'll pay me 5%. So keep in mind that the money market fund you mentioned is a mutual fund in Fidelity that invests in a short-term debt products like treasury bills, commercial papers, and CDs, right? If you don't know what those are, that's okay. I know when a lot of people hear the words mutual funds, they automatically think it's all stocks or a mix of stocks and bonds. But Fidelity has a list of money market funds that allow you to invest in short-term debt that focuses on federal agency notes, repurchase agreements, and they are generally considered safe investments. But you have to pay attention to the interest rates because they do come with some risks. And this is actually a video I wanted to make a while ago, but let me give you the breakdown anyway here, so you have a full understanding of it. So let me pull up the drawing board here. Nope, that's not it. That's it. Okay, so I'm not very good at drawing, so I'm just going to go ahead and type here. All right. So there are three different names when it comes to treasury securities, or what we call government issued fixed income securities. Okay. And that's there's the treasury bonds, treasury notes, and treasury bills. And treasury bonds, let me type that up here. So treasury bonds. Let me see if I can zoom in so you guys can see that better. All right. So treasury bonds are long bonds because their maturity dates are between 20 and 30 years. And you're going to receive a fixed interest payment every 6 months for investing directly in treasury bonds. You don't pay any state or local income taxes on the interest you earn, but you will pay federal income tax based on your marginal tax rate on bonds, bills, and notes, okay? And you can also sell a treasury bond before maturity, but the volatility is higher than a treasury note or a treasury bill. So it's not guaranteed that you can sell a treasury bond at its face value. So if you buy let's say a 30-year treasury bond at $1,000 and the value goes up to $1,020, then it's trading at a premium. But if it's trading at, let's say, $980, then it's trading at a discount. So if the price is above the face value, then your yield is going to be less than the coupon rate, right? And you have to keep in mind that treasury bonds are considered safe investments, but it comes with inflation and interest rate risks. So, and if inflation goes up, like it has been since 2022, then you're not going to have the same purchasing power that it did 30 years ago, right? And if interest rates rise, then the price of your bond will decline. And that's going to be a problem when you can't sell it for face value. And the longer your maturity is, the more the bond will be affected by the rising interest rates. And I know I'm getting super technical here, but let me know in the comment section if you enjoyed this type of content. And I talk about this in my private client program. So feel free to sign up for the one-on-one session by visiting advisor.com/coaching. But anyway, there are also treasury notes, okay, that have a maturity date of 2, 3, 5, 7, and 10 years. Okay, so treasury notes also comes with biannual interest payment, but offer lower yields than a treasury bond. So the 10-year treasury note is what CNBC, Bloomberg, all they talk about, because that's what people look at as a benchmark to set mortgage rates. So when inflation picks up, so do fixed mortgage rates, right? Now, treasury bills is what you're talking about here. Okay. Now, these maturity dates are for a let me think, 13, 26, or 52 weeks, right? So they're short term. So they don't pay you interest payments every 6 months like treasury bonds. So it's a short-term debt obligation or a short-term loan issued by the federal government. So when you buy a treasury bill, you're going to pay less than its face value and then receive the face value at maturity. What I like about the treasury bill is the fact that it's short-term and high liquidity, and they're supposed to offer lower returns than treasury bonds or treasury notes. But since 2023 and still in 2024, short-term treasuries actually have yielded more than the long-term treasuries. And you probably heard it from other people talking about the inverted yield curve. And this is what I'm talking about. A money market mutual fund that you're asking about will pay you an interest payment every month. So let me go ahead and pull up the Fidelity short term. There's one. It is called, let me see, FDRXX. So let me pull that up and show it to you guys here. So this is, in full disclosure, I do have money saved in short-term treasury, but in a mutual fund with T-bills, treasury bills, offered on the secondary market. This is not in any form of financial advice. I'm just here to show you how to read the chart, okay? So anyway, I think there's over $27 trillion just in U.S. Treasury securities in 2024. But when you read that, it's 4.98% right here for 7-day yield. It just means that the average income return over the previous 7 days is 4.98%. It's the total income net of expenses divided by the total number of outstanding shares. That's too technical, but just bear with me here. If it's yielding 5%, you got to keep in mind that this mutual fund charges you, let's see, there's an expense ratio right there. There we go. Gross expense ratio of 0.38% in annual expense ratio. So it's really paying you 4.62%-ish in net, right? You always have to keep an eye on the expense ratio when it comes to investing in a mutual fund. So if you click on, let's see, fees and distributions, you're going to see that this mutual fund pays you dividends every single month. It's really interest payment, but it'll say dividend on there. The net asset value is always going to be $1, but the share amount is going to be different every time. And remember that how much they pay you will also depend on how long you put the money in the market, in the mutual fund, right? The rates will also change because the mutual fund is tracking the overall short-term interest rates. And because the net asset value is always $1, so when you sell this mutual fund or money market fund, you're not going to owe taxes on the capital gains, but you will owe federal income tax on the interest that you received. And it's actually going to say dividends or dividend distributions if you invest in this one. Again, I'm not sponsored by Fidelity, and I'm just showing you this as an example. If you have Schwab or Vanguard, they have their own version of the money market fund that you can check out. But I hope that kind of helps out. And there are other Fidelity products that focus only on treasury securities. So please feel free to do your own research when you get a chance. And depending on when you're watching this video, the yield could be half of where it is now, or maybe even higher. And you'll need to pay attention to the rates and the expense ratio you're paying for. Just because it pays 5%, it doesn't mean that you're going to earn 5%. If you don't account for the management expenses, then it's really, you're not really getting that 5%. You're probably getting like 4.6%. You have to pay attention to the interest rates too. If you're going to save a significant amount of money in it, just make sure you know what you're using it for. I use it for my traditional IRA to keep my money safe so that I can make the backdoor Roth IRA conversion every year. Some people use it to save for the down payment of their home. I'm being very intentional with my savings. So you need to do the same before you just invest blindly into the market. Great question though. And I'll just put this video into a clip so people can watch it later. All right. Awesome. And we still got about 8 minutes. So let me answer another question here. And I do have Bloomberg ready to go. So, all right. Okay. I have another question I'm going to go ahead and answer. Okay. This one came from a YouTube comment. Not okay. I'm going to hide the name here real quick. Okay, while I'm doing that, it says, my dad wants to take out a HELOC on our home as his brother, who just moved to the States from Mexico, wants to get a home. My uncle doesn't qualify for a house on his own, as he literally just got here less than 3 months ago. And although he came to the country with around $25,000 saved, that still isn't enough to get a home. So my dad was trying to apply for a home for him, but he was only approved for $300,000, but they would need to make a $50,000 to $70,000 down payment. And obviously that's a lot of money. So now they're considering having my dad get a HELOC on a property. It was bought at $147,000. They owe $80,000, and now it's worth $365,000. I keep telling them it's dangerous to get a loan, especially a HELOC for his brother, but it seems like he doesn't care and is going to go forth with it. That's tough. Okay, so here's the thing. It's outside of your control. There's not much that you can do about that one. All right. So you can do what you can to provide as many resources as you can to have a better understanding of how HELOC works. There are a lot of risks to taking out a HELOC. And I don't know his entire situation, but it seems like he already made up his mind. But if you don't know what a HELOC is, it's a line of credit or a type of debt that allows homeowners to use their homes as collateral to tap into the equity of their homes, right? And I would never take out a HELOC for one simple reason. I would be putting my home at risk, and the equity in my home stays where it is until I'm ready to upgrade my next home and use that equity to apply for the next home I purchase. I don't plan on carrying a mortgage going into my 50s because I want to retire with absolutely no debt. And taking out a HELOC is a type of debt I don't want to carry on my FIRE journey. Now, you have to remember that HELOC is like a credit card. So you need to know what the annual fees is during both the withdrawal period or withdrawal and repayment periods. Okay. So if you end up biting more than you can chew, you're going to end up choking on it for a long time. And don't confuse a HELOC with a home equity loan. Or a home equity loan is when you borrow the lump sum you're approved for all at once from the equity of your home, and then you'll need to pay back both principal and interest within a time frame, and depending on the term of your loan. So you could have like 10 years, 20 years, 30 years, right? And most lenders will let you borrow up to 80 or 85% of your home's equity. So if your dad's home has an equity of $300,000, then he could borrow up to $240,000 out of that home equity. Now, I'm guessing it's not an investment property because You didn't mention that in the question, but if it is, it does come with stricter lender requirements and higher interest rates. Now, HELOC, let me show you this. I'm going to start typing this up a little bit. HELOC comes with 2 periods, okay? Now, one of them, it'll say draw period. The next one is going to be the repayment period. During the withdrawal period, you typically just make interest only payments, right? So typically, that's a variable rate like your credit card. So you have to keep an eye on what the Federal Reserve is doing. When they raised rates in 2022, people with HELOC had to increase their minimum payments because the interest rates went up, right? So if you already have a HELOC open right now, you need to have a plan to pay it back in full. The draw period usually lasts about 10 years, okay? It really depends on your lender, but typically what I see is 10 years. And when your HELOC enters the repayment period right here, you're going to need to have a plan to repay what you borrowed and the interest on top of it. So your interest payment could be a couple $100 a month, but when you enter the repayment period, that payment could go up a lot higher depending on your outstanding balance. You also have to keep in mind that you're going to have annual maintenance fees, transaction fees, and other management expenses. These are the risks people have to think about when they're thinking about tapping into their homes. And what happens if your dad misses his HELOC payments? His lender could potentially foreclose on this house to repay the debt because the lender basically owns his house now, right? So he's going to have a mortgage lender and a HELOC lender on top of it. And the other risk he needs to think about is what happens if his home value goes down. His lender could freeze or reduce his HELOC line of credit if his property value goes down. Just remember that you can only do so much for your dad. You already said that he doesn't care and he's going to go through with it, and maybe send him as many resources as you can to make sure he understands the risks behind a HELOC. If your uncle already has $25,000 saved, can you work a little bit longer to save another $25,000 towards a down payment? Now, your dad's going to leverage his house to pay for his brother's house, but he's also going to pay 10% or more in interest on his HELOC, right? For those of you watching this, do not rush to buy a house when you can't afford it. If you're not ready to buy a house, then you're not ready to buy a house. Great. Thanks for putting that in the comments. But I really hope that everything works out for you. So let me pull up Bloomberg here. Oh, let me do a refresh.
Evidence that 1Q was an outlier, but still thinks the first cut comes in December. Even with all that really constructive language about what we've achieved this morning, at least what they believe we've achieved this morning, Bank of America still believes the first cut comes later this year in December.
It sort of goes to the question that we don't know what confidence means, right? We're going to be parsing through every iteration, every word. If they need confidence, Bob, you were saying it doesn't have to be that much. But Tom, at a certain point, do they have to have more
Should
confidence
be announcing in about 30 seconds.
the speed bumps that you've seen along the way?
They're going to be exposed. I don't see many speed bumps. I see nominal GDP 5%. You help me with Michael Ferroli. Maybe it's 4.8%, whatever. But there's an underlying animal spirit that belies whatever first quarter GDP was, 1.3, 1.4%. There's more of an enthusiasm now that gets them in control to what they want to get. Maybe they didn't have control last meeting. He's got more control of the dialogue this meeting.
That decision is about 30 seconds away. Let's go through the scores going into that decision. Equity markets right now on the S&P 500, record highs. On the NASDAQ 100,
sometimes the website
record
crashes.
highs. On the Russell, a rally of 2.6%. In the bond market, which is where the fun and games have really taken place over the last couple of weeks, Lisa, back and forth, one narrative to the next, back and forth, day after day, from data point to data point.
Jim Bullard saying it concerns him, the idea that we're not seeing any kind of stability in the
All right,
bond
here we go.
market. At what point does it become disruptive? disruptive. Right now, we're still seeing that massive rally on the heels of a really positive CPI.
Maintaining the target
With your Fed
range,
decision
and they're going to
is
maintain the
Mike
rates at 5.25 to 5.5%.
2 dots, no rate move. The
Feature
median
Bloomberg.
of the 19 Fed officials' projection for rate cuts this year moves to 2 from 3 in March. Policymakers are quite divided, however. 8 members see just 2 cuts this year, 7 see only 1, 4 vote no change. They now have 4 penciled in for 2025, although the range is so wide, it's almost meaningless. The neutral rate also moves up. The median now 2.8% from 2.6%, although they don't get there until after 2026. 9 members see neutral as 3% or higher, 1 as high as 3.75%. The Fed's target range stays in the range of 5.25% to 5.5%. No change in the 2.1% GDP projection for 2024. 2% for next year. No change in the 4% unemployment forecast for this year, though 2026 moves up a tick from March to 4.2%. It's PCE inflation where we see the biggest change in the forecasts. Headline of 2.6 this year, up from 2.4% in the March projections. Next year, 2.3 from 2.2. Core PCE is forecasted 2.8% this year, up from 2.6%. Next year, also 2.3 from 2.2. Inflation was the only significant change in the statement following today's better than expected CPI. The statement now says, in recent months, there has been modest further progress toward the committee's 2% inflation target. The decision was unanimous.
Mike McKee, thank you, sir. If you were looking for fireworks in financial markets, you missed it all. It happened about 6 hours ago at 8:30 Eastern time. And the equity markets, some of these moves stick. On the S&P 500, still positive by about 0.9%. On the NASDAQ, up by more than 1 full percentage point. 2-year yields, Lisa, just off the lows of the session, but still down 12 or 13 basis points to 470 on a 2-year.
There's nothing that would really shake up what we saw earlier. It is interesting, though, that they did increase their expectation for core PCE inflation to 2.8% versus 2.6%. And it raises the question about the idea of, are they tacitly allowing inflation to go be 2 point something, to Mohamed El-Erian's point, rather than exactly 2%, as they allow this to happen even with 2 potential rate cuts baked in.
TK, what's your takeaway?
My takeaway here is that 8:30 was really, really important, and it moves us right on to all the other economic data. And I go back to economic growth, and it's a surprise this year that we get more buoyant economic growth than a lot of the gloom crew's talking about.
I want to get back over to Mike McKee. Mike, just briefly, just work through that again for us. Explain to us where that median dot is. We were looking for 3 cuts in the median dot last time around. Where's that median dot for 24 now?
The median dot is at 2 cuts for 2024, 4 for 2025, but the range has narrowed considerably, but still broad, because there are, at this point, 8 members seeing 2 cuts this year, so that makes it the median. 7 saw only 1, and 4 voted for no change.
Yeah.
So they seem quite divided, which would suggest that at this point, there is no consensus on the committee about what's going to happen the rest of this year.
Mike McKee, thank you, sir. Mike McKee will be in that news conference in about 27 minutes' time when it kicks off.
Yeah, we're going to find out more
in
about 27 minutes.
Powell in this presser based on that?
Yeah, I do. Number one, how long will you tolerate inflation above 2%? How quickly is an okay pace to move to get inflation down? And the second thing, I'm still thinking about this. One participant had a new neutral rate proposal of 3.75%. That's pretty bold. I mean, it's pretty much in line with where markets are for 3.5%. Nonetheless, that resets a lot of questions about market valuations that maybe on the margins could really change investment theses.
Joining us now to discuss is Mohamed El-Erian of Queen's College, Cambridge, Bob Michael of JP Morgan still around the table with us. Mohamed, I want to come to you first. Get your view on these forecasts based on what we learned earlier this morning at 8:30 Eastern time.
So I wonder, John, whether those forecasts fully reflect this morning or whether they were finalized before this morning. I was surprised to hear that 4 voted for no cuts, and I was surprised to see the inflation numbers go up. Both for the PCE, both at headline and core. So the one question I would have for Chairman Powell is, do those numbers and the expectations that 4 people had of no rate cuts reflect this morning's inflation data or not.
Mohammed Tamkeen, good morning and good afternoon, I should say. Good late afternoon and evening to you. Somebody today echoed Peter Orszag, a long time ago of LSE. That's a school, Mohammed, southwest of Cambridge. And Peter Orszag talked about glide paths. Is our great underestimation that the glide paths to get out of the pandemic with all this monetary policy is much longer time frame than we think? We're modeling Fed meeting to Fed meeting, the silliness of September and December, where we should be modeling 2027.
We should, Tom, and I've been urging to combine data dependency with more of a forward-looking view of the economy, but that's not where the Fed is, and as a result, that's not where the markets are. The markets are reacting to every single data point. In the last month, just the last month, 10-year yields went up 30 basis points, came back down 40 basis points, went back up 20 basis points, and came back down 40 basis points. And what you realize is that there's no anchor. There's no longer-term anchor to markets, and there's no longer-term anchor to policies. We should be talking about the big secular changes and how that's going to impact the next 12 months, but that's not where the Fed is, and therefore that's not where the markets are.
Right now, I wonder how significant it is to you, Mohammed, that we did see at least one participant materially mark up their long-term neutral rate as people try to understand what this means longer term for what a Fed rate cutting path could look like.
It's about time. I mean, you know, there is a very active discussion of what's happening in the structure of the economy and why it is that the neutral rate is well above 3, nearer to 4. But the Fed is moving very slowly on this, and Fed Chair Powell has refused to engage in discussions, either saying, I don't care about it, or I don't have a view about it. So yeah, it's about time. They're going to have to really think about this. But again, Lisa, that is a forward-looking parameter. And this is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
So if you are just joining us, welcome to the program. Equities still firmer by 0.9% on the S&P 500. We were higher by more than 1 full percentage point. Just undoing some of the moves in the bond market on a 2-year yield. Yields are lower still by 12 basis points. They were lower by a little bit more than that earlier on. There was a lot of interest in the median dot for 2024. Just want to clarify something that Mike was saying. They're now signaling they expect to cut rates only once this year compared to the reduction of 3, which was kind of signaled back in March, Bramo. So that's the change we were looking for. Would we come down for 2 or to 1? It looks like we've come down to 1, but 2025 kind of makes up for some of that in some way.
Which is what some people were saying, is that you just basically push it out to the following year, which is why it might not have been a massive deal. There was a big question before this, whether or not it would matter to markets on the margins. Maybe you take back some of the gains in certain bonds right now. Nonetheless, not a huge shift when you look at the overall cutting cycle.
Well, Michael, I've got the 10-year yield just touching 2 standard deviation move. It's not a big deal, 4.28%. And gyrating around. What level of 10-year yield do you need to really signal, to use Bullard's word, a new regime?
It's not so much the 10-year yield as the front end of the curve.
Yeah, okay.
I think the front end of the curve, you've got to see the Fed start cutting rates and then the front end start coming down towards 4%. I think that will pull the 10-year down as well a little bit, but there's an awful lot priced into the 10-year part of the yield.
This is an unfair question. I'm going to ask you to speak for Michael Feroli and Kasman and the other economists at JP Morgan.
Okay, I'm going to pause on this real quick. I know they're just kind of chit-chatting, but let me just show you what they were just they're talking about right now. So the dot plots just showed up, and I do want to show you this, and I did a comparison between those two from the previous. Let me see if I can expand that. Can I? Nope, cannot. All right, cool. So this is what they're talking about. This is from the previous FOMC or the when it came out, right? So 4 members right here voted to maintain the Fed funds rate between 5 to 5.5%. So they voted to maintain that. So 4 of them, whichever ones they are. But now additional 7 members, this is today's report, came out at you know what? That's a terrible drawing, but let me see if I can just undo it here. So right here, okay, so additional members have voted to maintain the rates high. Now, while the rest of the members maintain below 5%. Now, is this going to change when the next one comes out in what, September? Yes, absolutely, it could. So this is what they're talking about. This is from the previous one. As you can see, this is from March 20th, and I just did a screenshot on this, and this one is showing the June 12th. And now going into 2025, this one person has maintained the same rate above 5.25 to 5.5%, but someone did vote to maintain the rates high between 4.75 and 5%. And now it looks like the majority of the FOMC members or the voting members are keeping below 4.5% over here. Okay, so how that's going to look going forward is really going to depend on the data they're going to collect, and we're going to listen to what Jerome Powell is going to talk about at the meeting here. But it looks like they're going to in 2025, if we see any deflationary indications, you know, regardless of where they are, I think they're going to go down to below 4.5%. It just really depends on the PC inflation. Now, I want to pull up the summary of economic projections. Let me see. Should be able to pull that up here. Okay. Share. I have like 50,000 screens going on at the same time right now. Okay, here we go. All right, so this is the current rate of what's going on. So let me go and share that here. Let me go to the first page. So this is what I was talking about earlier in the live stream. So right now, if you can see here, let me see if I can draw on this. Can I? You know what? Let me open up the PDF file here. It might be much better so I can highlight it and present it a little bit better here. Let me pull up Adobe. Highlight, can I? I don't want to sign. There we go. Okay, much better. All right. So this is the June one. And let me see. All right, so the last report said that real GDP was going to be at 2.1, but now they're saying that it's still going to maintain, still going to maintain at 2.1%, okay? Now, Q1 GDP came in at 1.3. Maybe they're seeing a better outlook for the rest of 2024. We'll see, right? This could change next time it comes out in September, or maybe the one in December. And if you look at the one below, can I sign? No, I don't want to sign it. Let me see. Draw. Can I draw this? No. Guess not. Okay. So if you look at the March, the one below is the March projection. That was from the previous one. Now, this is the current one, the 2.1. So if you want to look at the changes in between the top line and the second line, okay, that's what Bloomberg was just talking about here. Now, unemployment rate, this is interesting. They're keeping the unemployment rate unchanged at 4%. That is their projection. That's what they're looking at. Now, unemployment rate just came out for the month of May. It's already sitting at 4%. Now, this is something that is a little bit interesting, is they're projecting to go up to 4.2 in 2025 as opposed to 4.1, and then 4.1 in 2026, okay? Now, PC inflation, they bumped this up, and that's what Bloomberg was just talking about, is they moved it up from 2.4 to 2.6. So they're going to talk about that. Jay Powell is going to talk about that at the press conference, but he's going to say that we're going to see a longer inflation, much more. It's going to last a lot longer, above 2%. So their target rate is 2%, no matter what, right? So now that we're seeing that going from 2.4 to 2.6, is that what the Fed is seeing? Yes. And does that mean that they're going to keep the rates higher a little bit longer? Also, yes. Okay. Now, the same thing with the core PCE, 2.8 versus 2.6. Now, take a look at the Fed funds rate. 5.1. It's increased from 4.6. So what does that mean for the range? Okay. So they're going to keep that Fed funds rate between 4.9 to 5.4. The previous one said 4.4 to 5.4. That's a wider range, but now they're tightening it to make it between 4.9 and 5.4. So there's a chance that they're going to cut rates twice, possibly. But right now they're looking at just cutting rates once by the end of the year is what I'm guessing. They're going to talk about that at the press conference, but I just don't see the rate cut coming at all if the labor report continues to come in hot, and if the Fed funds rate remain at between 5 to 5.5%, and if they just cut the rates by just once from 5.25 to 5.5%, I think they're going to cut it probably in November or December. I don't even see that September cut to be happening. So let's take a look at what was it, a CME watch tool. See what it says now. Do the refresh. Hang on 1 second. Yeah. So June is over, and that's going to be taken out. For July, it's going to be 89.3% chance they're going to keep the rates where it is. Yeah, I think that they're just going to keep that where it is. But September, they're still looking at about 60% chance. I don't think the rate cuts are going to come until November or possibly December now. And now between now and, let's see, CPI schedule 2024. So between today, June 12th, and then June 11, August 14, September 11, October 10th. So between now and the next FOMC meeting, there's only going to be one CPI report coming out, right? But between now and September, we're going to see three more CPI reports. If the data does downtrend, and now the FOMC meeting in September, which is going to be September 18th, that's going to be key there. And we're going to be able to find out by then if the data is downtrending. If not, like I said, if it's doing this and then going back up and then going back down, then the Fed is going to be like, nah, we're going to keep the rates steady where it is. If it's going downwards, just straight up downwards, then I could see them cutting rates in September. So we're going to find out more in about 12 minutes when the Fed gets the go in front of the press and find out more. So let me do this real quick. I'm going to share the screen. I'm going to get more Q&As in the meantime. Let me see here. Pull up Bloomberg in the meantime. There we go.
They've been looking over it, and came in strong with how they were going to talk about it in the morning. And I think they still have members of the board itself that would have gotten the data that would have said, hey, we're still on the sidelines here, or one cut and that's it. So I think that's an important way to be thinking about where they're at, about what they think they need to be convinced on inflation coming down, not to get to 2%, to cut before they get there, but how much they need to be convinced. That's a lot. And I think they've set that bar pretty high. And it's because they have been head faked in the past. That doesn't mean we couldn't see some big improvement and get to September cut, but I think we need a lot of improvement from here for the Fed to feel convinced to do a September cut.
Suddenly this news conference in 12 minutes got a lot
Exactly
more interesting. Dan Swan of KPMG. Dan, thank you. As always, if you are just tuning in and you missed the Fed decision, it took place about 18 minutes ago. Rates unchanged as expected. Big focus on the median dot. Basically, all the Fed officials get together. They plot where they think rates should be, will be for 24, 25 and beyond. You take the median dot, and a lot of people on Wall Street see that as a signal of how many times they're going to cut in any given year. That median dot was at 3 cuts for this year. It's come all the way down to 1. Worth noting, though, that they now see 4 cuts in 2025, more than the 3 that they previously outlined. So they've pushed some of that into next year. But the range of views, I think the median marks a very, very divided Fed. And Lisa did a fantastic job of that a little bit earlier, really explaining it, Lisa, that 4 policymakers see no cuts this year. 7 anticipate just 1 reduction. 8 are looking for 2. That's the Federal Reserve that's all over the place.
And that really does have at least half of it a really hawkish tilt right now at a time when other people are saying, you know, we'll do it for the Fed, mission accomplished. So it raises this question at this point, what is keeping them from really going all in on the immaculate disinflation? Is it just PTSD from Q1? And will all of the sort of questions that people have around the hawkishness just disappear in the wake of the bomb that Jay Powell tends to bring us?
Mike Gapen of Bank of America is with us now for more. Mike Gapen, I was sharing your words a little bit earlier, that quote from you, one giant leap for the Fed. Then I explained that you still don't think they cut until December, so it's not that big a leap. What do you make of what you've heard in the last 20 minutes or so?
Well, if we thought it was September or a sooner cut, maybe it'd be one giant leap for mankind instead of the Fed. Like I think what Bob and Mohammed have been saying here, I think I would share, which is I think the data is probably more important than the dots in this case, because it is such a data dependent Fed. They don't want to take these structural longer term views, so they'll be reactionary. So maybe that the dots kind of lag.
Okay, I'm going to cut this out just real quick because Jerome Powell is going to be addressing the press in about 9 minutes. I'm going to take one more question here. So, all right. So can you explain a little more about the Roth conversion for 5 years? How should I plan for FIRE with the early retirement using a Roth conversion? So 5-year Roth conversion is when you have money inside your traditional IRA, traditional 401k, 403b, TSP, anything in pre-tax, right? So traditional is on pre-tax and Roth is on after-tax. So there's a conversion strategy that you can move your, let's say, 401k from traditional 401k, and then you can convert that to Roth IRA by paying taxes now so that you can let that money grow inside Roth tax-free. And then when you turn 59 and a half, you can enjoy the earnings and interest tax-free as well, okay? So how that works is that when you're, let me share the screen first. So when you are, let's say, I'm going to just give you an example. Let's say you have a traditional 401k. Then you've been saving and you have we'll go with $500,000 invested, all right? And that is making you about 8% average annual return. Okay. Now you are getting ready, you're retired and you want to move that traditional 401k to a Roth IRA. Now, so the first step is to move that traditional 401k to traditional IRA. And then you can convert traditional IRA to Roth IRA. Remember, this right here is a rollover. And this right here is called a conversion, okay? So when you convert right here is when you have to make, let me see if I can turn it into a bullet. Probably not, okay? So let me go ahead and bring this down a little bit. So anytime you make a conversion from traditional IRA to Roth IRA, you're gonna have to pay federal income tax. So if you convert all $500,000, you're going to pay federal income tax for $500,000. That puts you at a marginal tax rate at about 32%. No, it'll be a little bit higher, pretty close to 35%. And I don't know what the effective tax rate is going to be depending on that. So what most retirees choose to do is they actually wait until retirement to do it, because your income is going to be a lot lower than your when you're working, okay? Assuming. Now, do you want to convert all $500,000 at the same time? No, right? Because if you pay income tax on $500,000, I mean, let's just say 35% marginal tax rate, that would be hefty. So what people do is actually do 500K, and let me see if I can do divide. There we go. Divided by, let's say 10 years. That would put you at about $50,000 a year. Now, paying income tax on 50K is, let's say you're single, that would put you at about, just above 12%, so at about 22% marginal tax rate. That is way better than 35%. Now, this is not any specific financial advice or tax advice to you, but just keep that in mind. And if you're married, filing your taxes jointly, then it would be 12%, or married filing jointly. Okay, for 22% would be single or married filing separately. So when you plan for retirement, let's say you want to make that money work and you have that pot of money going into your Roth every single year. I mean, you just pay minimal taxes, as little as possible. It really depends on the age that you're going to be retiring at. So let's say you retire at age 55, just use that as an example. You can just directly take money out of your 401k under the rule of 55. So it wouldn't make sense for you to really convert that unless that is a sources of income, that you have multiple sources of income that you're trying to minimize taxes later on in your retirement. It really depends on your situation. Okay, so this is not a one size fits all plan, just kind of giving you an example. So if you have a lot of money invested in your traditional 401k, just remember that you have the rule of 55, that you don't pay any penalty on the 401k withdrawal, but you will pay federal and state income tax. Okay, now let's say you retire at age 50. So what do you do with the age 50? Now, when that happens is if you have traditional 401k for 500k, then you can do 50k. I'm just giving you an example here. Let's say 50k a year, age 50, and then 50k a year for age 51, so on and so forth. So when you get to age 55, then you can take that money, 50k out, tax free. That's where the 5-year conversion rule comes in. When, let's say I retire in 2024 and I convert $50,000 from the traditional 401k to the Roth IRA, I can't touch that money penalty free and tax free until 5 years later. So 2024. So I can take that money out in 2029. There's no age rule for the tax conversion, okay? Because I already paid taxes on that. Keep that in mind. It doesn't matter if it's an earnings and interest, because when you convert that 401k out of a traditional 401k into Roth IRA, again, that is, you're paying taxes on the entirety of that conversion. If you convert $100,000, you pay taxes on the $100,000. It's federal income tax, not capital gains tax. You got to keep that in mind, because it is, you put that money in there in pre-tax contributions. That's really the key thing here. So when you put money into Roth IRA, okay, so let's say, let me put this on there. Let's say at age 55, you have $50,000 in converted and met 5-year rule. Okay, so what that means is that you have met the 5-year rule because you converted that from 2024, and then in 2029, and it doesn't matter what month it is, if I convert it on June 12, 2024, I can take that money out as of January 1st, 2029, because I met the 5-year rule and I already paid taxes for the tax year 2024. You pay taxes now so that you don't pay taxes later. So you can do that 5-year conversion strategy. So by age 56, I'm going to have another 50K tax-free. Age 57, another 50K tax-free. So that's going to be really key when it comes to retirement planning, because you want to minimize your taxes as much as you can. And if you can just kind of like plan out, 58, 59, and then age 60, I'm sorry, that would be 5 years already. So 55, 56, 57, 58, 59. And if you can make $50,000 every single year tax-free, that is going to be really huge for your retirement planning, because you may have other taxable income coming in from traditional 401k that you're taking out, or maybe you have real estate income during your early retirement, or you may have pension income that comes in earlier if you're a policeman, police officer, firefighter, or whatnot. So just keep that in mind, because your pension income is going to be taxable income. And having these, and if you convert early, and you can kind of set your timeline for 5 years, 5 years, 5 years. But when you convert at age 50, you're doing it at 50, you're withdrawing at 55. If you convert at 51, you're going to withdraw at 56. You just continuously convert until you run out of traditional 401k. So I hope that answers your question. Really good question. Having 401k and Roth IRA, those are the two core accounts that you want to have for your FIRE journey, is to have a 401k with your employer and then your Roth IRA or traditional IRA, because those are individual retirement accounts. 401k is a employer-sponsored retirement account. So those are the two big differences. So just make sure you keep that in mind. But great question. All right, let me go ahead and share, because Jerome Powell is coming in. Here we go. There he is, just in time. There we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Here we go.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So It's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming a good but not great numbers, and if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher, 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Timmeros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one that we saw this morning make a September interest rate cut possible?
Oh, good question.
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls, but we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response, which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. But, and I'm not going to get into the specifics, but you have the ability to do that so that, you know, what's in the SEP actually does reflect the data that we got today to the extent you can, you know, reflect it in one day. I think we'll, you know, you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, you know, kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, you know, some people generally do, but most people generally don't.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago. And we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, you know, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit. And you know, that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though you know, there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully. And that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, you know, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, you know, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. How can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the what did we take away from this? We had really, really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long run neutral rate of interest is a long run concept. It really is a theoretical concept, can't be directly observed. And what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, you know, very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces, and you know there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, you know, the effects that we would hope for.
Well, thanks, Chair Powell. Howard Stein with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You know, you can translate it into the language you're talking about, but to me the focus is more on, we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And you know, in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy rate now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic related distortions to both supply and demand. And that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and you will see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more
So
about
I think that's true that that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters. And I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. So, but we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year. And I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth, solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there were renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. we do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
Cyclical sectors.
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So, and also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things, because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's,
imagine taking a shot every time he says confident
there. And we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Last question. Go through the
Hi, Chair
summary.
Powell, Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Wow. Okay. So let me just summarize what he said, and we're going to go from there. And yep. So if you are just tuning in, the Federal Reserve, they came out with the SEP. So that would be the summary of economic projections. So 3 months ago, it was about 3 rate cuts. Now we're looking at 1 rate cut with 4 meetings remaining. So we just had the meeting today. That was they decided on keep the interest rate steady at 5.25 to 5.5%. And we have a meeting in July. We have a meeting in September, November, and December. A lot of people, including myself, I don't think there's going to be a rate cut happening in July because there's not going to be enough data from now until July to see that rate cut to happen. So we have 1 CPI reading happening next month in July. And I'm going to go ahead and share that screen here in a minute. But the next CPI reading is going to be on July 11th. That's going to be for the month of June. And that's not going to, and then 3 weeks after that, we're going to have another FOMC meeting. So my guess is that they're not going to move any rates unless they see some weaknesses in the labor reports and maybe the GDP reading for the Q1. So remember, the Q1 GDP third estimate is coming out on June 24th. I talked about that in the last live stream. So what's really interesting is that in the SEP here, I'm going to show you this in here. Share screen. Okay. So the SEP I went over right here. What's interesting is that they're still predicting that the GDP is going to be at 2.1% for 2024, which is the same as the last projection that they came out with. But the Q1 GDP is already coming in at 1.3%. Originally, it was at 1.6, and now it's at 1.3 due to lower consumer spending. Okay. Now, unemployment is at 4%. In 2025, they're looking at 4.2%. But the unemployment rate is already at 4% for the month of May. So they're either being conservative or maybe they're thinking it in a different way. But unemployment rate possibly staying at 4%, unlikely. I personally think this is going to go up to as high as 4.5, but it could end end the year with 4.2%. We'll see what happens because the labor participation rate has come down a lot. And he did mention immigration earlier in the during the press conference. So we'll see what happens with that one. But I think this is going to be a lot higher than 4%. I think it's going to go as high as 4.5%. Worst case scenario, if they start to see like cyclical sectors like hospitality sector, they start to see some job losses, I think that would be a trigger for the Fed to say, all right, we need to start cutting rates because now the labor force is becoming weaker, okay? Now, PC inflation. Now, this is interesting because we're already at 2.7, 2.8%. So one of the journalists, they asked, hey, we're already at 2.7. We're already at 2.8. Why are we not cutting rates now? And your SEP is already showing 2.6 and 2.8. Now, he is saying that, okay, well, we want to be more conservative going into the next CPI reading because today's reading was really good, right? Because it came in lower than expected. But we want to see that trend to go downwards instead of just going back up and then coming back down. If they cut rates now, then they don't want to risk inflation just flaring up again going into July, August, and September. Typically, American people do spend more money in the summertime, summer months. They travel more, and then obviously during the Christmas time in December, they do the same thing. So what comes down to it is, a lot of them asking, all right, so now it's come down to one rate cut. Why even cut the rates at all if inflation is, still at 2.8 for core PCE, and then CPI came in at 3.3 this morning. So the Fed funds rate 4.9 to 5.4. Right now we're at 5.25 to 5.5. So they decided to just do one rate cut. Is it going to be in July? Most likely not. It's the CME group is betting on September right now, but that's really 50-50 chance. I personally think it's probably going to happen in November or December, unless we see some data that the next 3 CPI readings. Let me show you this for the dates. There we go. CPI reading. So today's June 12th, right? And then the next one on July 11, August 14, and September 11. So for those 3 dates, 3 CPI readings come in weaker and weaker, going from 3.3, 3.2, 3.1, 3%, and that core CPI starts coming down too. Then the Fed could say, all right, let's start cutting rates in September. Remember, September 18th, that is the same date. They're going to have that FOMC meeting, but they're also going to have the new SCP. So this is probably all going to be changed too by September. We'll see what happens. But they didn't really make any changes for the GDP for this SCP, which is really surprising after what we saw from the Q1 GDP. And the unemployment rate already at 4%, and they didn't change it to 4%. And at the beginning of this live stream, I was saying that it's probably going to change to 4.2, 4.3. They did change that for 2025, but they kept it at 4.0. Now, what he was talking about, the dot plot here. So majority of the FOMC participants, or the people who vote, right? It's not Jerome Powell he's not the only one who decides on this. So most people are keeping the rates steady between 5 and 5.5. And the other half, they're like between 4.75 and 5%. So if the data does show a lot more weaknesses going into, say, September, these dot plots could potentially go back down to 4.75 to 5%. They might do 2 more rate cuts instead of just 1. We'll see what happens. So that's one thing that he did repeat over and over again, is that if the data, they need to see more data, right? And the risk of waiting for the data to come out, especially with the labor report, is that it is a lagging indicator. What does that mean? The employment data that comes in is from a month ago. So we could be seeing more weaknesses now, and the risk of doing that is then the Fed is reacting too slow, and they've reacted slowly before, to cut rates to stimulate the economy. That's how it goes. Longer the interest rates stay high where it is now, he said that there's going to be some weaknesses that's going to happen later on. So they are expecting to cut one time to by about 25 basis points, whether that's September or November. We'll see what happens. Now, the other thing I wrote down was the FOMC meeting in July. So that's one CPI reading. That's why I don't think that the rate cuts are going to happen in July. But for September 18th, we're going to see 3 CPI readings. So the rate cut is more likely, not definitive, but it's more likely, right? I personally think it's going to happen in November. Now, the labor report is right now at 4%. And someone in the crowd asked, what if it goes to what would be the indicators for you to start cutting rates? Would it be 4.5% or something like that? He just said that it's in general, like all the broad labor data in general that he needs to look at. Personally, I think he needs to look at more of a cyclical sectors like hospitality, restaurants, all those places. If they start to see some job losses, if the data goes from positive to negative, then they're probably going to start cutting rates, and we'll see about that. So again, the SCP was really important for us to read it. Then the other issue, obviously, is the political pressure that he's getting about, housing affordability, right? He really can't do much about that because housing affordability, it's not because the interest rates are, that's not the only reason why it's high. It's the inventory level. I mean, think about it this way, right? I mean, someone in the comment section in the live chat just said that he has a 2.3% mortgage rate since 2013. And why would you want to move out of a house at a 2% mortgage rate and move into another house that's potentially 7% interest rate, and that's going to increase your housing payment unless you can afford it? Most Americans can't afford that 7% mortgage rate with the pricing level that we're seeing right now. So that's something else that someone asked, hey, would you consider home affordability into your rate cut decision-making process if you're going to make any rate cuts because of the home prices coming down? He said no. That's more of a one of the maybe contributing factors, but we'll see what happens with that. Consumer confidence, somebody else asked that. It is at not an all-time low, but it is like a 15 or 20-year low. We'll see something like that. If consumer confidence continues to go down, usually it's more of a psychological game at that point, right? So if I say, oh, I'm gonna a recession is coming and I'm gonna sell whatever, other people would kind of be affected by that. I mean, I hope you don't think that way. I want you to have your own opinion with how our economy is going. What I want you to do going forward is really just understand what the Federal Reserve does with their monetary policy and what Congress is doing, besides racking up debt and what they're doing, right? But they're in charge of the fiscal policy. Why does this matter to the people on the FIRE journey? We're investing. We want to see what's going on with the market. The market is doing okay today. There's been a little bit of downward towards the end of the day. Well, we got like 27 minutes left on the market, but I want to see where I can buy more assets so I can retire earlier, or I can achieve FIRE or fat FIRE, lean FIRE, whatever it is that you're doing to get there faster so that you understand what the market is doing. But what I don't want you to do is like, I'm going to hold on to all the cash so that I'm not going to invest anything because there's a recession coming. You're going to see that article every single day. Somebody's going to put out an article saying that, oh, there's going to be a recession next year. I've been seeing that article like every single day, right? You should always invest steadily, weekly, bi-weekly, it doesn't matter what. Just when you have your 401k, Roth IRA, or HSA, or any long-term retirement accounts, you should always invest consistently. Now, if you have some short-term, like say taxable investments that you're doing, like say you're doing call options, something more risky, that would be a good reason for you to kind of pay attention to what the market is doing. But anyway, really good press conference. And it's kind of weird that Jerome Powell was in a much better mood today than he's ever been. But yeah, that's funny. McDonald's is a fancy restaurant. It is. Yeah, that's like $12 for one sandwich and a medium fries, man. But yeah, just really really interesting how this is going to go. But this is a great day to do double live streams. Don't do this very often, but the next one is not going to be till July. But I do go live stream every other Wednesday. Next one is going to be from 2 weeks from today. I don't know what the topic's going to be in 2 weeks, but it's always going to be about the FIRE investments, early retirement strategy, or whatnot. So just bring your Q&As if you want to. Really appreciate all of you guys being here. Really can't appreciate you guys enough for supporting my channel. So, but yeah, if you have any questions, just contact me, or you can get all the free resources by going to firesidechat.com/resources. But with that said, until next time.